Every other asset on Earth is diluting. It's bleeding monetary energy. There's only one thing in the economic universe that isn't. According to Michael Saylor, Bitcoin isn't a currency. It's the invention of digital property. It's an economic black hole that he believes will absorb the monetary energy of the world. There's a crisis unfolding, and it's not the one leading the nightly news. It's happening quietly in your wallet, your bank account, and your retirement portfolio. It's a slow bleed, eroding the value of everything you work for. Every dollar you save, every stock you own, every piece of real estate you invest in, they're all sitting on what Michael Saylor calls a melting ice cube. This isn't just a pessimistic theory. It's his observation of a fundamental flaw in our entire economic system. For centuries, we've tried to find the perfect way to store value. We've used shells, salt, gold, and government paper, but every single one has a fatal flaw. Someone can always make more of it. And if more can be made, you can bet it will be. When a central bank wants to goose the economy, it prints more money, silently taxing every dollar in your savings. When a company wants to raise capital, it issues more shares, diluting your piece of the pie. This process is what Saylor calls the bleeding of monetary energy. You pour your life's work into accumulating assets, hoping they'll hold their value for your future, but the containers are all leaky. This is the great financial dilemma of our time. As the CEO of MicroStrategy, Saylor faced this problem head on in 2020. He was sitting on $500 million in cash, and he realized it wasn't an asset, it was a liability. It was losing purchasing power every single second. He had a choice: keep playing a game that was rigged for a slow, guaranteed loss, or find a different game entirely. His search led him to what he now calls absolute, verifiable digital scarcity. This is the heart of his final warning. The world is splitting into two kinds of assets: those that bleed value and the one that doesn't. He argues we are on the verge of the greatest wealth transfer in human history, a migration from leaky analog assets to a perfect monetary vessel. The warning is simple: understand this shift or get left behind holding assets that will bleed out over the long term. To really get where Michael Saylor is coming from, you have to wrap your head around a concept he brings up again and again: absolute scarcity. It sounds simple, but its implications are massive. For all of history, scarcity has been relative. Take gold, humanity's best shot at a store of value for 5,000 years. Gold is scarce, sure, but if the price doubles, we just pour more money into mining it. We find new veins, develop better tech, and we can even theoretically mine it from asteroids. The supply of gold grows by about 1 to 2% a year. It's a slow leak, but it's still a leak. Or real estate. They aren't making more land, right? But we can build up, turning one block in Manhattan into a million square feet of usable space. Bitcoin, as Saylor frames it, breaks this model. Its scarcity isn't relative, it's absolute. There will only ever be 21 million Bitcoin. This isn't a company promise, it's a principle enforced by a decentralized global network and hardened by code. Changing this rule would require a consensus so overwhelming that it's considered practically impossible. As of late 2025, over 93% of all Bitcoin that will ever exist has already been mined. Its inflation rate is already lower than that of most major economies, and it's programmed to keep falling until the last fraction of a coin is mined around the year 2140. Saylor calls this the invention of digital property. For the first time, you can own something in the digital world that can't be copied or debased. You can email a picture to a friend and you both have it. But when you send Bitcoin, you don't have it anymore. You've transferred the actual digital property. He argues this makes Bitcoin digital capital, not digital currency. A currency is for buying coffee. Capital is for preserving wealth across generations. You don't price your lunch in shares of Apple stock, and in his view, you shouldn't price it in Bitcoin. You use dollars for that. But if you want to store the profits from a lifetime of work, you should put it in the hardest asset ever created. In Saylor's mind, this invention is a phase change for money, like water freezing into ice. Monetary energy is flowing from weaker forms and crystallizing into the final solid form of Bitcoin. It's not just an improvement on old assets, it's a whole new thing. If you accept the idea of absolute scarcity, the next step in Saylor's grand theory is his concept of the monetary black hole. It's a powerful analogy for his seemingly wild price predictions. The idea is that if Bitcoin is the only asset with perfect monetary gravity, it will inevitably pull value from every weaker asset. So what is this monetary energy? It's the estimated $900 trillion of wealth currently stored in stocks, bonds, real estate, and cash. All of these, as we've established, are leaky buckets. The world is slowly waking up to this. For decades, investors have played a complex game of moving their money between these buckets, just trying to find the one that's leaking the slowest. But what happens when an option shows up that doesn't leak at all? This is the black hole theory. In physics, a black hole's gravity is so strong that nothing can escape. Saylor argues that Bitcoin's absolute scarcity gives it a similar economic gravity. At first, the pull is weak, only affecting the cypherpunks and early adopters. But as Bitcoin's market cap grows, its gravitational pull gets stronger and it starts affecting bigger things. First, it pulls from weak national currencies in places like Argentina or Nigeria, where people are using it for survival. Then it pulls in retail investors in developed countries who see it as digital gold. But the crucial phase, which Saylor believes we entered around 2020, is when the gravity becomes strong enough to pull in the supermassive objects, corporate treasuries, and institutional capital. This is exactly what his company, MicroStrategy, did. He thinks every public company will eventually have to make the same choice. This creates a flywheel effect. As institutions buy Bitcoin, the price goes up. This increases its market cap, which strengthens its monetary gravity, pulling in even bigger institutions like pension funds and sovereign wealth funds. He sees the spot Bitcoin ETFs as giant vacuum cleaners, hoovering up capital from the old financial world. This institutional demand has at times dramatically outstripped the new supply being created by miners. The end point of this theory isn't that Bitcoin just becomes another asset class. It's that it becomes the primary global reserve asset. It absorbs the monetary premium from gold, real estate, and even stocks. In this future, the price per coin reaches numbers that sound unreal today, $1 million, maybe even 10 million. But in Saylor's framework, these numbers aren't just speculation. They are the mathematical result of trillions of dollars trying to fit into an unchangeable supply of 21 million. Of course, every big idea gets hit with a wave of skepticism. Saylor has faced a firing line of criticism, but he methodically dismantles each argument with an engineer's logic. First up is volatility. Critics point to the wild price swings as proof that it's just a speculative bubble. Saylor's response? He says volatility isn't a flaw, it's a feature. It's the price you pay for watching a new global asset get monetized in real time. He compares it to the chaos of a waterfall of capital flowing from a $900 trillion ocean into a tiny, pristine lake. As the lake fills, the surface will naturally calm down. Then there's the energy consumption. This is a big one. But Saylor, an MIT-trained engineer, counters that any system securing trillions of dollars must be energy-intensive to be safe. He argues that Bitcoin miners are incentivized to find the cheapest power on the planet, which is often stranded or wasted energy, like flared gas or remote hydropower. Because of this, he claims Bitcoin is becoming one of the cleanest, most efficient industries in the world. What about a government ban? Saylor sees this as a fantasy. Bitcoin is decentralized. There's no CEO to arrest or headquarters to shut down. Banning it would be like trying to ban the internet. In his view, we're past the point of no return. Governments aren't racing to ban it. They're in a race to figure out how to embrace it. The ultimate rebuttal to all the doubt, according to Saylor, is the institutional stampede. This isn't theoretical anymore. The approval and success of spot Bitcoin ETFs in the US created a regulated bridge for trillions of dollars to flow into the asset. Big name banks are now getting into custody services. MicroStrategy itself earned a credit rating from S&P, a landmark moment opening the door for a new class of institutional investors. This isn't a fringe movement anymore. Hundreds of firms are starting to copy the MicroStrategy playbook. The institutions are here, and their arrival, Saylor argues, is making the old doubts obsolete. So, what does the world look like after Saylor's monetary black hole theory plays out? He paints a picture of a completely reordered financial universe. In this future, Bitcoin isn't just trading at $150,000, a price he predicted for the end of 2025. It's not even at $1 million. He has projected that as Bitcoin absorbs the monetary energy from other assets, its value could one day reach staggering figures. These aren't just numbers plucked from thin air. In his model, they're the result of immense demand meeting a perfectly inelastic supply. In this world, Bitcoin serves as the planet's primary reserve asset, the bedrock of the economic system for individuals, corporations, and even nations. But currencies like the US dollar will still exist. The dollar will be for transactions, for buying groceries, and getting paid. But no one with a long-term view will save in dollars. Any surplus cash will be quickly converted from high-velocity currency into the long-term storage energy of Bitcoin. This brings us to the final warning. The warning isn't that Bitcoin is going to zero, it's that the window to acquire a meaningful amount of it is closing and fast. Saylor calls the decade between 2025 and 2035 the gold rush years. He believes this is the last chance for the average person to get in before the truly massive wave of institutional capital arrives. After that period, nearly all Bitcoin will have been mined. Acquiring it will mostly mean buying it from someone who already owns it, and prying a perfect asset from their hands will likely command an astronomical price. Bitcoin will transition from a high growth tech asset to a mature global reserve asset. The door that is open today may be effectively shut for most people. His message is urgent. Holding on to Bitcoin now makes you an early pioneer. Selling it for a flashy car, he says, could be a multi-million dollar mistake you'll regret for the rest of your life. The time for debate is over. The logic is simple. You can either stay on the melting ice cube or step onto the solid ground of a closed monetary system. This isn't an investment tip. It's a warning that the world's economic software is being rewritten right now. Michael Saylor's framework isn't just about making money. It's a challenge to everything we've been taught about value. His thesis isn't a get-rich-quick scheme, but a profound argument that the very idea of property is being reinvented before our eyes. The best path forward isn't to blindly follow anyone, but to adopt the same intellectual curiosity that led Saylor to his conclusions. Do the work. Read books like The Bitcoin Standard to understand the history of money. Listen to Saylor's interviews to hear the arguments from the source. Challenge his assumptions, test his logic, and decide for yourself. The final warning is not a command to buy, but a call to understand. A technologically superior asset has been unleashed into a world of infinite printing. This is a one-time event. You have a brief opportunity to understand it and position yourself for a radically different financial future, or you can ignore it. For now, the choice is still yours.